I want you to stop whatever you're doing right now. Close every other tab. Put your phone face down, because what I'm about to walk you through is not a prediction. It is not a theory. It is not some YouTube finance guy speculating about something he read in a headline. What I'm about to walk you through is the direct application of 40 years of watching debt cycles build, peak, and collapse. 40 years of managing billions through every major market dislocation of the modern era, from Black Monday in 1987 to the dot-com implosion, from the 2008 financial meltdown to the COVID liquidity flood that followed. I have seen this exact setup before. I have seen it in different countries, different currencies, different asset classes, and I have never, not once in 4 decades, seen it resolve quietly. It never does. The math doesn't allow it. And the math right now is the worst I have ever seen. Here's what almost nobody is saying out loud, and I think the reason nobody is saying it is because the implications are too uncomfortable for most people to sit with. We are not approaching a credit problem. We are not on the edge of a credit problem. The 2026 credit collapse has already begun. It began quietly, the way these things always begin, not with a crash, not with a front page headline, not with a single moment you can point to and say that was the day everything changed. It began in the plumbing. It began in the parts of the financial system that most people never look at, never think about, never hear mentioned on television. And by the time it becomes impossible to ignore, the window to protect yourself will have already closed for most people. I want to start with something that happened to me personally, because I think it illustrates the single most important thing you need to understand about what is coming. In the year 2000, I was managing the Quantum Fund. I had publicly warned for months about the technology bubble. I was writing memos about it. I was in meetings about it. I watched companies with no revenue, no path to profitability, not even a coherent business model, trade at valuations that were simply disconnected from any rational framework. I was so certain the bubble was going to collapse that I was actively short, meaning I was betting against the most overvalued names in the technology sector, and I was right. The analysis was completely correct, but I still lost $3 billion in 6 weeks. I want to dwell on that for a moment, because it contains the most expensive lesson of my career. Being right about the analysis and making money from that analysis are two entirely different things. Watching younger traders in the fund make enormous gains while I sat on the sidelines with my shorts, I couldn't handle it psychologically. My ego overrode my discipline. I abandoned my own system and poured $6 billion into the very stocks I had been warning everyone else to avoid. Within 6 weeks, half was gone. $3 billion evaporated because I let what other people were doing with their money influence what I did with mine. I rebuilt. The fund recovered. But I never forgot what that felt like, and I never forgot the lesson embedded in that failure. The lesson was not about market timing. The lesson was about the psychology of crisis. When something is collapsing, the most dangerous thing in the world is watching other people appear to profit while you protect yourself. That temptation will return in 2026 and 2027 more powerfully than most of you have ever experienced. And I am telling you now, before the pressure arrives, what it will feel like and what the correct response is. Now let me show you the actual numbers, because this is where it gets uncomfortable. Total United States debt, as of right now, sits above $90 trillion. Government debt alone, just the federal government, has crossed $35 trillion. I want you to understand the scale of that number in a way that goes beyond just saying it. If you had started spending $1 million every single day from the moment Julius Caesar crossed the Rubicon in 49 BC, you would not have spent $1 trillion yet. We owe 35 of them. But the number itself is not even the most alarming part. The alarming part is the velocity. The interest payments on that debt have now surpassed what the United States spends on national defense. Read that sentence again. The cost of carrying the debt has exceeded the cost of maintaining the most powerful military in the history of human civilization. In every debt cycle I have studied across 500 years of financial history, that crossover point, when debt service exceeds defense spending, marks what I would call the terminal stage. Not the beginning of the problem. The terminal stage of a problem that began decades ago and was allowed to compound unchecked. When you reach the terminal stage, history tells you with remarkable consistency that only three outcomes are possible. The first is default. Governments or major institutions simply stop paying what they owe. The second is restructuring, a negotiated rearrangement of who gets paid how much and when. The third is inflation, the quiet default, the one politicians always prefer because it destroys the real value of debt without technically breaking any promise. In every case across 5 centuries of recorded financial history, the people who survived and prospered through these transitions were the people who owned real assets, who held capital that couldn't be inflated away, who had positioned themselves before the crisis arrived rather than scrambling after it became obvious. And the people who were destroyed were the ones who were caught holding paper. Currency, bonds, promises, in a world that had decided promises were no longer worth what they used to be. What I want to spend the next part of our time on is the specific mechanisms through which the 2026 collapse is transmitting right now, because understanding the mechanism is what separates people who see it coming from people who are confused by what seems like random chaos. The first mechanism is corporate credit deterioration. Over the past decade, corporations were handed effectively free money. Interest rates near zero meant that even companies with mediocre business models, weak cash flows, and questionable management could borrow enormous amounts of capital at almost no cost. They used that capital not primarily to build factories, hire workers, develop new products, or expand into new markets. They used it primarily to buy back their own stock, to pay dividends, and to make acquisitions that looked impressive in press releases but often destroyed long-term value. Now those loans are coming due. The refinancing environment is completely different. Rates that were near zero are now dramatically higher. Companies that took on debt when money was free are discovering that the cost of rolling that debt forward is sometimes 2, 3, even 4 times what it was when they borrowed. For the weakest borrowers, what the market calls high yield or junk, the stress is already acute. Default rates are climbing. Credit spreads are widening. These are the early signals, the tremors before the earthquake. And they are flashing right now if you know where to look. The second mechanism is the commercial real estate implosion, which is already underway and is dramatically underappreciated by most people. Commercial real estate, office buildings, retail centers, certain categories of industrial and mixed-use property, was priced during the era of zero interest rates based on assumptions that are now simply false. The cap rates, which is the return you earn on the income a property generates relative to what you paid for it, made sense when you could finance the purchase at 2%. They make no sense whatsoever when financing costs 5, 6, 7%, and the income side of the equation is under pressure too. Office occupancy in major American cities has not recovered to pre-pandemic levels, and many analysts believe it never fully will. The regional banks, the mid-size institutions that are the backbone of lending to small businesses, local developers, and community construction are sitting on commercial real estate loan portfolios that are quietly hemorrhaging value. They can't sell these loans at current market prices without taking losses that would threaten their solvency. So they are sitting on them, extending maturities, hoping that rates will fall fast enough to save them. Some will be saved. Many will not. And when the regional bank failures accelerate, the credit contraction that follows will hit the small businesses and local developers who depend on them the hardest. The exact layer of the economy that is most responsible for job creation and community economic activity. The third mechanism is the consumer credit exhaustion that almost nobody is talking about because the headline unemployment numbers have remained relatively stable, and that has convinced most observers that the American consumer is fine. The consumer is not fine. Credit card balances in the United States have hit all-time records. The delinquency rates on those balances are climbing at a pace that has not been seen since 2008. Auto loan delinquencies are at levels that should be setting off alarm bells everywhere. The buy now, pay later products that proliferated over the past several years, the ones that allowed people to split purchases into installments and feel like they were spending less than they actually were, are now generating delinquency data that their issues are disclosing very quietly in footnotes that almost nobody reads. The savings rate has collapsed. The excess savings that households accumulated during the pandemic stimulus period have been spent. The consumer, who has been carrying the American economy on her back for the past 3 years, is running out of runway, and when consumer spending contracts sharply, as it will when credit tightens and delinquencies force lenders to pull back, the growth numbers that everyone has been pointing to as evidence that the economy is resilient will evaporate. Now I want to talk about something that I think is even more important than the specific mechanisms, and that is the question of timing. When does the market actually price all of this in? And what happens to different types of assets when it does? The frustrating and essential truth is that markets can remain disconnected from fundamental reality for longer than any rational person expects. I learned this the hard way in 2000. I was right about the technology bubble a year before it collapsed. Being early and being wrong feel identical in your brokerage account. So I am not going to stand here and tell you that the collapse will arrive on a specific date. What I will tell you is that the window is measured in months, not years. The signals that have historically preceded major credit dislocations, the credit spread widening, the yield curve behavior, the regional bank stress, the consumer delinquency acceleration, are all present and all moving in the wrong direction simultaneously. When multiple signals align like this, the historical pattern is that the dislocation arrives faster than anyone predicted and is more severe than anyone modeled. So let's talk about what you actually do. And I want to approach this the way I approach every portfolio decision, which is through what my friend Charlie Munger called inversion. Instead of asking what should I buy to protect myself, ask first what would guarantee that I am destroyed by this crisis, and then make certain I am not doing those things. What guarantees destruction in a credit collapse? Leverage. Carrying debt into a liquidity crisis is the single most reliable way to be wiped out. When credit contracts and asset prices fall, leverage positions face margin calls, forced selling at the worst possible prices. The investor who was correct about the direction of events, but was carrying borrowed money, is forced to liquidate at the exact moment they should be buying. I have watched brilliant people, people who understood the economics better than almost anyone, get completely wiped out in credit collapses because they had leverage. No amount of analytical brilliance compensates for the structural vulnerability of a leveraged position in a liquidity crisis. If you are carrying consumer debt, particularly high interest consumer debt, eliminating that debt is the single most important financial decision you can make in the next 12 months. Not because of the interest cost, although that matters, because leverage in a credit collapse is existential risk, and removing it removes that risk entirely. The second guarantee of destruction is illiquidity, owning assets that you cannot sell when you need capital. Certain categories of private investment, illiquid real estate positions, long lockup funds. These can be wonderful in normal environments and catastrophic in crisis environments. In a credit collapse, liquidity is not a luxury. It is the difference between being a buyer and being a forced seller. The people who prosper through credit collapses are almost universally the people who had the capital and the liquidity to act when distressed assets became available at prices that would have seemed impossible 12 months earlier. Lehman Brothers collapsed in September 2008. Within 18 months, the people who had dry powder and the courage to deploy it into distressed credit and beaten down equities and undervalued real assets made returns that compounded for a decade. They could only do that because they were liquid when everyone else was desperate. Liquidity is the weapon. You cannot use a weapon you don't own. The third guarantee of destruction is concentration, having your financial well-being tied to a single asset, a single employer, a single geography, a single currency. Credit collapses are unpredictable in their specific path. What you can predict is that the damage will spread in ways and to places that nobody expected. The person who feels completely safe because they own one really good house in one really solid market may find that market is not as solid as it appeared when credit contracts and forced sellers flood the local market with supply that wasn't there 6 months ago. The person who feels completely safe because they have a great job at a great company may find that great company is not immune to a credit crunch that forces it to cut costs. Diversification is not a strategy for modest returns. In a credit collapse, genuine diversification across asset classes, geographies, and currencies is a survival strategy. Now let me talk about what historically preserves and grows wealth through periods like what is coming, because I do not want this conversation to be only about fear. Fear without a path forward is paralysis, and paralysis is itself a decision, usually the wrong one. The assets that have historically preserved wealth through debt cycle collapses share a common characteristic. They are real. They represent actual ownership of actual things that have actual utility that cannot be printed into worthlessness by a central bank. Real assets in different forms have different risk profiles and different mechanisms of protection, and I want to walk through them with the specificity that I think this moment deserves. Gold has been the global reserve of value for 5,000 years because it has no counterparty. It is not a promise. It is not a claim on someone else's future performance. It is not subject to the creditworthiness of a government or an institution. When I say the 2026 collapse is a credit collapse, what I mean at its core is that promises are going to be revealed as worth less than people thought they were. In that environment, something that requires no promise, something that simply is what it is, becomes extraordinarily valuable relative to everything that depends on promises being kept. I have historically maintained meaningful gold exposure in my portfolio, and I would increase that exposure materially in the environment I see developing right now. not as a speculative trade. As an insurance policy and a hedge against the most dangerous tail risk in a credit collapse, which is currency debasement, equities are more complicated. And I want to be precise about this because I think the conventional wisdom that stocks always go up in the long run, so just hold on, is dangerously incomplete for the specific period we are entering. Stocks are real assets in the sense that they represent ownership of actual businesses with actual productive capacity. But they are also priced based on expectations of future earnings and future cash flows. And those expectations are currently embedded in valuations that assume a level of economic activity and a cost of capital that may not materialize. When credit contracts and the cost of capital rises, the discount rate applied to future earnings rises, and that mathematically compresses the present value of those earnings. This is not theory. It is arithmetic. The question for equity investors right now is not whether to own equities, but which equities to own and on what terms. Businesses with genuine pricing power, the ability to raise prices without losing customers, will be dramatically more resilient than businesses that compete primarily on cost in commoditized markets. Businesses with strong balance sheets, low debt, and high free cash flow generation will be dramatically more resilient than businesses that depend on continuous access to capital markets to fund their operations. Businesses that provide essential goods and services that people genuinely cannot do without will be dramatically more resilient than businesses that depend on discretionary consumer spending that is the first thing cut when household finances tighten. I want to be concrete: energy infrastructure, certain categories of healthcare, essential consumer staples, and select technology platforms with genuine network effects and high switching costs are the categories where I would concentrate equity exposure today. The high, multiple speculative growth names, the companies where all the value is in earnings that are 5, 7, 10 years away, are the names I would avoid with conviction in a rising rate environment that persists through a credit contraction. Those distant earnings get discounted so severely that the current price becomes very difficult to justify. Let me talk about something that I think deserves far more attention than it typically receives in these conversations, and that is the international dimension of what is coming. The United States dollar, for all the fiscal dysfunction that has characterized American policy over the past decade, remains the world's reserve currency, and that status confers enormous privilege and enormous responsibility simultaneously. When the credit collapse accelerates, the initial response of global capital will almost certainly be to flow toward the dollar, toward U.S. treasuries, toward the perceived safety of American sovereign debt, even though that sovereign debt is itself part of the problem. This is what happened in 2008, and it seems counterintuitive until you understand that in a global crisis, investors are not looking for the best option. They are looking for the least bad option. The dollar and U.S. treasuries win that competition by default in the near term, but the medium-term trajectory is different. If the resolution of this debt crisis involves inflation, and the political incentives point overwhelmingly toward inflation as the preferred mechanism, then the purchasing power of those dollars and those treasuries will be systematically eroded. The countries that may outperform in that medium-term environment are the ones with sound fiscal positions, commodity-rich economies, and currencies that are genuinely undervalued relative to purchasing power parity. I am watching Brazil, certain parts of Southeast Asia, and select commodity exporters with significant interest, not as recommendations, but as the geographic areas where the fundamental case for outperformance in an inflationary credit resolution scenario is most intellectually compelling. I want to come back to something psychological because I said at the beginning that the 2000 disaster was ultimately a psychological failure more than an analytical one. And I think the psychological dimension of what is coming is as important as the financial one. Here is what a credit collapse feels like when you are living through it. And I want you to have this experience in advance so that when it arrives, you recognize it and respond with discipline rather than emotion. In the early stages, which is where we are right now, nothing feels like a crisis. The market is volatile. There are concerning headlines. Certain sectors are under pressure. But the overall system is still functioning. Banks are still lending, albeit more carefully. Companies are still making payrolls. Consumers are still spending, albeit with more reliance on credit. The people who are protecting themselves and reducing risk at this stage look conservative, overcautious, possibly even foolish to their peers who are still fully invested and still making money. This is the hardest part of the entire cycle. The temptation to abandon your discipline because the crisis hasn't fully arrived yet is enormous. I felt it in 2000, and it cost me $3 billion. Then comes the inflection point, which arrives faster and more violently than almost anyone expects. A significant institution reveals a problem. A market that was assumed to be liquid reveals that it isn't. A credit instrument that was assumed to be safe reveals that it isn't. And suddenly, the collective psychology shifts from complacency to panic, with very little transition in between. In 2008, it was Lehman. But Lehman was not the cause of 2008. Lehman was the moment when the problems that had been building for a decade became impossible for anyone to ignore. The cause was the decade of bad loans, mispriced risk, and leverage that preceded the moment. The specific trigger doesn't matter. What matters is that when the trigger arrives, it initiates a self-reinforcing cascade. Lenders pull back credit. Businesses that depended on credit for operations face sudden stress. Asset prices fall. The falling asset prices trigger margin calls and forced selling. The forced selling drives prices lower still. Consumer confidence collapses. Spending contracts. Revenue falls. More stress. More tightening. The cascade is self-reinforcing because every component feeds every other component, and breaking the cascade requires either an enormous external force, typically a government or central bank intervention of historic scale, or simply allowing the cycle to burn through until all the excess leverage is extinguished. Here is what I know with the certainty that 40 years and billions of dollars of hard experience can provide. The people who are buyers during that cascade, not at the exact bottom, because nobody catches the exact bottom, but somewhere in the zone of maximum fear and forced selling. Those people are the ones who build the kind of generational wealth that changes the trajectory of families. They can only be buyers if they are not already forced sellers. They can only be not forced sellers if they don't have leverage. They can only deploy capital if they have liquidity, which is why every specific recommendation I have made in this conversation traces back to the same principle: remove leverage, build liquidity, own real assets, and position yourself to be a buyer when everyone else is desperate to sell. Now let me talk about the specific timeline as I see it, with the caveat that timing is always the hardest part of macro investing, and I have been early before. The signals I am watching most carefully in 2026 are the credit spread data, specifically the spread between high-yield bonds and U.S. Treasuries, which measures how much extra return investors demand to hold risky debt. When that spread widens rapidly and persistently, it signals that the credit market is pricing in a deterioration in the ability of borrowers to repay their obligations. We are seeing widening now, And if the pattern that preceded 2001 and 2008 holds, the widening accelerates meaningfully in the quarters ahead. The second signal I am watching is the regional bank stress data, specifically the unrealized losses on commercial real estate loan portfolios, which are disclosed in regulatory filings that most people never read, but which paint a picture that should be deeply concerning to anyone who understands what they are looking at. The third signal is the Treasury market itself, specifically whether foreign central banks and institutional holders continue to absorb the supply of new U.S. government debt at yields that don't compensate for the inflation risk embedded in a government that is running trillion-dollar-plus deficits as far as the eye can see. If demand at Treasury auctions weakens materially, if the so-called tail of auctions, which measures the gap between expected and actual yield required to clear the auction, if that starts widening persistently, that is the signal that the bond market itself is beginning to question the trajectory of American fiscal policy in a way that could be very disruptive very quickly. I want to spend a few minutes on what I think the policy response will be, because understanding the policy response is as important as understanding the underlying crisis when thinking about how to protect yourself. When the credit collapse accelerates to the point where it becomes impossible to ignore, the Federal Reserve and the Treasury will face an impossible choice that they have faced before and resolved in only one way. They can accept the deflationary cascade, allow the bad debt to be written off, allow the over-leveraged institutions to fail, allow the economy to contract through the adjustment, which is economically necessary and politically catastrophic. Or they can intervene with the tools that they have, cutting interest rates, expanding the balance sheet, purchasing assets, guaranteeing obligations, printing dollars, which buys time and prevents the acute deflationary collapse, but stores up inflationary pressure that ultimately detonates in a different and arguably more damaging way. Every time this choice has been presented in modern financial history, the political system has chosen intervention, not because interventions is the economically superior choice in the long run, because intervention is the politically survivable choice in the short run. And politicians, by definition, are optimizing for short-run political survival. The implication is critical for your positioning. The crisis will likely begin with deflationary dynamics, falling asset prices, credit contraction, economic slowdown, and then transition to inflationary dynamics as the policy response overwhelms the deflationary forces. The portfolio that survives the deflation phase and prospers in the inflation phase is not identical to the portfolio optimized for either phase alone. Navigating the transition requires flexibility, liquidity, and the ability to shift positioning as the nature of the crisis evolves. This is why I keep coming back to liquidity as the master principle. Cash feels like a terrible asset when inflation is eroding its purchasing power. But cash is the option that allows you to respond to every other opportunity as it presents itself, and in a rapidly evolving crisis. Optionality is worth more than almost any specific bet on the direction of any specific asset. Let me tell you what I would actually do if I were starting from scratch right now, with no existing portfolio and the full understanding of what I believe is coming. First, and without any hesitation, I would eliminate all high-interest consumer debt, credit cards, auto loans at high rates, personal loans. Gone. The return on eliminating 8% to 20% debt is guaranteed, tax-free, and risk-free. No investment I can identify offers that combination. Second, I would build a cash reserve large enough to cover at minimum 6 months of living expenses and ideally 12, held in short-term treasuries or a high yield money market account, where it earns meaningful return while remaining fully liquid. This is not an investment. This is armor. Third, I would allocate meaningfully to gold, not through a gold ETF necessarily, but through physical gold or the closest equivalent available to me, understanding that this is not a trade, but a multi-year position sized to hedge against currency debasement. Fourth, I would evaluate every equity position I hold through the lens I described earlier: pricing power, balance sheet strength, free cash flow, essential products or services. And I would eliminate positions that fail, that test even if it means recognizing losses. The cost of holding the wrong positions through a credit collapse will vastly exceed the cost of the tax loss or the emotional discomfort of admitting an error. Fifth, I would look at commodities with genuine interest, not as a speculative trade, but as a real asset allocation that benefits from the inflationary resolution of the debt cycle that I believe is the most probable long-term outcome. Energy, agriculture, copper, and other industrial commodities that are essential to actual economic activity and the actual construction of the infrastructure that governments around the world are committed to building, regardless of what happens to financial markets. Sixth, and perhaps most importantly, I would ruthlessly protect my human capital, my ability to earn income, develop skills, maintain professional relationships, and grow my capacity to create value in whatever economic environment arrives. That is the asset that no market crash can take from me. Investing in education, in skills, in health, in relationships. Those investments compound in every environment and cannot be wiped out by a credit collapse. And the last thing I want to say, the thing that I most want you to carry out of this conversation and hold on to through what is coming, is this: the 2026 credit collapse will create genuine hardship for many people. I do not minimize that. I do not celebrate it. Financial crises are not abstract events. They are the reason families lose homes, businesses close, careers are derailed, retirements are postponed. But every credit collapse in recorded history has also been, simultaneously, the greatest wealth transfer opportunity of its era. The reason is simple. Assets moved from the hands of people who were forced to sell them, because they had leverage they couldn't sustain, because they had no liquidity buffer, because they panicked at exactly the wrong moment, into the hands of people who were prepared, who had capital, and who had patience, and who understood that maximum fear is the friend of the long-term buyer. Warren Buffett